Hello, hi, welcome back, marhaban, assalamualaikum, and good afternoon, everyone. In this video, I'm going to discuss accounting for leases. This is a very technical part in accounting. So I'm using this textbook from Loftus, published by John Wiley and Son Australia Limited. So this fall under chapter 10. So let us look what are the things that we are going to cover today. First, I'm going to explain the purpose of AASB number 16 or equivalent to IFRS number 16. Then we are going to look on accounts for leases from the perspective of lessee, yeah, and another one from the perspective of lessor. So we have lessor, lessee. And then we are going to look at the finance lease and operating lease from both perspective, and also account for operating lease. So we have two types of leases. The first one is finance lease, the second one is operating lease. And finally, I'm going to provide what are the disclosure requirements under AASB number 16 and IAS number 16. IFRS number 16. So as an introduction, leasing is a means of gaining access to the benefit of an asset without owning the assets. So this is a bit new for certain industry. For example, maybe normally we purchase motor vehicles. Okay, we borrowed money from the bank using the hire purchase loan, and then the car become ours. Yeah, we transfer the right, the car registered under your name, and you have control. You have ownership. Yeah, you enjoy the benefit and also take the risk on that particular assets. However, later on, we have so many ways of gaining the benefits. One of the way is by using leasing, whereby the asset is owned by another party, and then you have the right to use the assets to enjoy the benefit from having that assets. So this is fall under accounting for leases. Okay. So under AASB number 16 or IFRS number 16, it replaced the previous ASB 117 or IAS 17. So under this new standard, it states that the lessee must recognize all their leases on the statement of financial position. So if you lease an asset, so you have to put this lease in your financial statement, in your balance sheet, statement of financial position, because it will result in more faithful representations and also enhance disclosure and greater transparency. So these are the things that we're going to discuss in this video. So what is a lease? The ASB number 16 define lease as follow: a contract or a part of contract. It can be a part of contract that conveys the right to use an asset. So this is the most important thing, right to use an asset. We call it as the underlying assets for a period of time in exchange for consideration. So the transfer of the right to use is essential in this definition. When you have the right to use the underlying asset for a certain period, it falls under a lease. Okay. For example, I give you a simple example. There are many automobile companies now provide leases option, whereby you can pay certain amount of money, for example, maybe for 5 years. So during that period, you have the right to use that vehicles, and after 5 years, you are going to return back the vehicles to the automobile company. So this is example of leases. The concept of underlying assets and identified assets are used interchangeably. Sometimes we use underlying asset, sometimes we also use the term identified assets. So customers' ability to derive benefit from use refer to the potential economic benefit, which make it fulfill the criteria or definition of assets. That is relates to the potential economic benefit. Okay, how and for what purpose the asset is employed, how the asset is operated, and the operator of the assets. If the lessor has a substantive right to substitute the assets, then the contract is not recognized as lease, as the right to use the asset has not been transferred. What does it mean? The lessor, the company that give a lease to you, they have the right to change the assets, to replace the assets from you. So in that context, we cannot say it fall under the lease because the right to use the asset has not been transferred. It's still in the hand of the lessor. So there are two parties involved in the lease contract. The first one is the lessor, or we call it the owner of the asset, and they retain ownership under the lease agreement. Whereas the second group is known as lessee. They obtain the right to use the asset. They can use the asset, they can use the vehicles, they can use the machine, not the ownership of the asset itself. They don't have the ownership, they only have the right to use the asset. So in return for the right of using the assets, the lessee must pay the lessor a series of payment, every month, maybe every year, every quarter to the lessor as compensations or as part of the deal in the lease contract. The lessor gives the right to use the asset to the lessee, and the lessee will going to pay a payments or series of payment to the lessor. So this is the basic idea or concept about lease. Apart from that, there is also non-lease component of the lease agreement. For example, the company the lessee agreed to pay maybe 15,000 per month. But that 15,000 might not 100% is the component of the right to use assets. It can include executory costs or intangible asset. I did put here example of the executory cost is maybe cost of ongoing lease agreement. For example, utility, repair, insurance, maintenance. So these costs should not be included as the asset, should be excluded from the right to use calculations. The right to use is the assets, reported in your statement of financial position. Okay. So let us see this example. This illustration comes from the textbook, okay, about the identified asset or underlying asset. So this example give you what it means by identified asset, the importance of this identified asset in recognizing accounting for lease. Okay, OCO Limited is the owner of a fiber optic cable that connects Sydney to Jakarta. The cable has 20 fibers. 20 fibers. Okay. Telco Limited enters into contract with OCO Limited for access of the fiber optic cable. They don't mention which cable. They have 20. Okay. The contract allows Telco Limited to use any of the 20 fibers. You can use fiber number 1, fiber number 2, fiber number 3 during the contract term to transmit data. So now Telco has the right. Telco has the right to use the assets. Telco has the right to use the fiber optic cable. But there is no clear identification of which fiber optic cable. They have 20 there. So the question here is, does the contract qualify as lease? Certainly the answer is no. Why? Because we don't have any specific, any identified assets in this agreement, in this contract. Okay, let me read the answer here. Although the amount of fibers of a telco use is specified in the contract, there is no identified asset, no identified assets, and therefore there is no lease. The contract is for access of the capacity of the asset rather than explicitly or implicitly specified asset. So you don't have the control, you don't have the right on specific asset. It's more general. If OCO Limited dedicated specific fiber in the cable to exclusive use, mean only can only be used by Telco Limited, then the contract would be an identified asset, hence qualify for a lease. So this is what we call as the concept of identified assets. Okay, let us move to the second example. Okay, example 10.2, Neighbors Limited is a healthcare provider that enters into a 4-year contract with a supplier for specialized diagnostic radiography equipment. This is for the hospital. Neighbors Limited will hold and use the equipment at one of its private hospital to provide a healthcare services to the patients, to their patients. The equipment can only be operated in conjunction with consumable products. Okay, you have the equipment, but you also need some consumable products. Okay, the purchase of the consumable product is included in the contract. So, in the contract, not only to the diagnostic radiography equipment, but also the contract include consumable product. The consumable product that enable you to use the equipment. Okay. The consumable product, however, also available for purchase separately from the supplier or other supplier. You can buy from the supplier or you can buy from different supplier. So does the contract qualify as a lease? We go back to the concept of identified asset. Do we have this underlying or identified asset? The answer is yes. Can we separate the cost of consumable from the cost of this diagnostic radiography equipment? Yes, we can do that. It's very easy, yeah? So there is a lease in this case because the right to use the specialized equipment is separate component for the contract. It's separate. Neighbors Limited can derive benefit from the underlying asset with or without the purchase of consumable from this current supplier. So in this example, the right to use the diagnostic radiography equipment fall under a lease. One more example about substitution right. MBOP Limited supplies electronic data storage. Telco Limited into a contract with MBOP Limited for the use of dedicated means specific server to store data. So this is identified. The contract allows MBOP Limited to substitute another identical server or dedicated server at any time without Telco Limited consent. What happens is the provider of the server can change the server, the identified server, to any server at any point of time without consulting with Telco Limited. So this is what I call as substitution right of lessor. Yeah? So MBOP Limited can give effect to the substitution at a nominal cost to it. So does the contract qualify as a lease? So the answer is no, there is no lease because there is no identified asset. Even though at the beginning it says you have this dedicated server, yeah, to store the data, but later on it seems like the MBOP has arrived at any point of time to transfer or to replace you with another server because the supplier has a substantive right to substitute the asset, can change the asset at any time, at any time. If the substitution required MBOP to incur significant costs in the transfer and to backup the data, then the supplier would not have a substantive right of substitution. In this case, the contract would be for an identified asset and can qualify for a lease. What I mean here is if the MBOP can replace if you a telco with another server and have to incur another cost, maybe the backup cost, penalty, or whatever, so it can be fall under a lease because it's not absolute right of substitutions because they need to incur additional costs for that.